Hi everyone, my name is Piterpakulski. Today we'll continue building financial model of a nail salon from scratch. And today we'll be talking about a very important coefficient which is called loan coverage ratio. Why it is so important. If you're planning to get a loan for your business idea, it's very important to know how this loan affects your operating profits. How much money is left after your loan payments are done. So how the loan payments affect your business idea during the period when your business is only reaching the break-even point. How these payments of your business in general. So that's why you need to know.
Maybe after usually when people see when business owners see the value of this ratio, they start sometimes rethinking the way they are going to finance their business ideas. So maybe they start thinking that it better invest more of their money rather than taking a loan. So that's why this ratio is very important. So today I will be showing you how you can calculate this ratio. I hope this video will be useful for you. You may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. So let me just add a line here. I will call this line loan coverage ratio. And the value, how it is calculated. So we need the cash flow statement built for calculating this ratio. So we are taking the result from operating activity, and then we divide it by the totals of principal payments that we pay for the bank and interest payments. So we will adjust the formula like this. Here we can, let's add a loan to our project and see how it will affect the financial efficiency. So here we added a loan. Then now we will extrapolate this formula to the right, to the whole of our timeline. So zero means that we don't have loan payments at this moment. So if the loan coverage ratio is negative, this means that we have even an operating losses at this moment. We don't have an operating profit at all. So operating profit is revenues minus direct expenses minus payroll minus fixed expenses minus taxes, and this is the operating profit. So if the operating profit is negative, then the loan coefficient ratio will be negative as well. But what is interesting, when the operating profit gets positive like this, the loan coverage ratio will be still less than 1. So the rule for loan coverage ratio is the bigger the amount of loan coverage ratio, the better your business idea works with your loan. So the easier for you to pay interest to the bank. So if the loan coverage ratio is less than 1, this means that you don't have even, that your operating profit isn't even enough to pay your debts. And this is a serious story, because you have to rethink your business concept, or you have to put more money from your pocket to finance your business idea at the first during the first stage of your business idea. So now we can see how the loan coverage ratio is growing. So this means that at these 2 months we do have a positive operating profit, but the operating profit is less than the totals that we pay to the bank. So this is the operating profit, these are total payments, this is the profit payments, and this means that we have to put some additional financing from our pocket to compensate this difference between profit and our payments to the bank. And here is the first moment when a loan coverage ratio becomes more than 1, and this means that the operating profit is bigger than the total amount of money that we pay to the bank. And so the bigger this amount, the first rule is that the loan coverage ratio should be more than 1. If it is less than 1, this means that your project isn't capable of paying the debt. The second rule is that if it is more than 1, it should be as much as possible. So you can go from left to right and see that sometimes, because the business, for example, is your business idea is seasonal, so in some places loan coverage ratio decreases, then it increases. So you will learn many new things about your business idea while you will be looking at loan coverage ratio, while you will be looking at cash flow statement. So the very important indicator to investigate the way you will be financing your business idea. So maybe you're better to find some business partners, because you suddenly find out that that loan sufficiently affects operating profit, and it's better for you to choose another way of financing, less heavy than a loan. Maybe you should find another bank with a lower interest rate, or some another way of another type of loan, because for example, you may find a loan with a greater grace period for interest payments or principal payments. So you have some, for example, 6-month or 12-month grace period, and when your business reaches the break-even point, you will be easily able to pay the debt. But during the first period, when your project just reaching the break-even point, it is very hard for your business idea to cope with operating losses plus bank payments. So you'll be looking at this moment and at loan coverage ratio and see how your business idea performs, especially during the first 6, 7, 8 months of its operating activity, of its life cycle. So this is extremely interesting. So looking at this coefficient, you will be able to learn many new things. You will start rethinking your business concept. You will start making new scenarios. So I hope that this video was valuable for you. You may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. So see you guys in next videos. Thank you and bye.